time, we defer more questions to the end. And we go to the second talk. So it will be given by Lakshithe Wagalath from IÉSEG School of Management. And it's about risk management for whales.
Thank you, Carol. You
should go to the poisson geometry.
Yeah. Thank you, Georges, for the invitation, as always. It's a great pleasure to be back in Rio at this period of the year. And happy birthday to Raphael. Huh? It's good to see you. So I'm going to talk about a paper that we wrote with Rama a few years ago, actually when he was still at Imperial, which is called Risk Management for Whales. So it's actually in the vein of what we've been doing with Rama over the last years, well, when I started my PhD with him, which is how to incorporate the effects of big players on financial dynamics and financial risk, right? So it's probably going to be interesting to people like Raphael or others, like Stefan here. So a little bit of introduction and motivation. Well, the first starting point of this work was looking at how risk is computed, at least in a practitioner's framework, and this is something that Carol actually discussed during her mini course. If you look at what regulators ask financial institutions to do, is that they use very simple risk measures, such as value at risk or expected shortfall, to calculate a given measure of the risk of a portfolio, right? So you look at, I don't know, at a 99% value at risk over 1 day or 1 week, or same thing for the expected shortfall. And then you have a number, right, which enables you to, which is supposed to represent the risk of your portfolio, right? And if you look at those measures, those risk measures, they are actually scaling linearly, meaning that if I have a portfolio which has a certain given risk, if I multiply the size of this portfolio by 100, well, if I use value at risk or expected shortfall, the risk is also multiplied by 100. So it's scaled linearly. And it actually comes from the fact that those risk measures are homogeneous. So it means that the risk of lambda times the portfolio is lambda times the risk of a given portfolio. Right? And once again, I'm talking about those risk ones, those risk measures which are used in practice. But if you think about it, why do we calculate the risk of a portfolio? We calculate the risk of a portfolio so that we know the losses of an institution in extreme scenarios, right? When things go really bad. So, for example, when in the 1% worst scenarios or in the 0.1% worst scenarios. And then we take this number, so this value at risk and this expected shortfall, to calculate the capital which is required for a bank, or to calculate the margins which is required for a fund detaining a derivatives portfolio, something like that. So we calculate how much of an institution should have to kind of cover those extreme losses. Right? But the thing that we forget when we use measures such as value at risk or expected shortfall is that when you look at those extreme losses, so I'm not talking about the intermediate losses which can occur like on a regular basis, but when you look at extreme losses, so the ones that happen 1% of the time, or maybe less than 1% of the time, well, in those scenarios of extreme losses, very often the fund which is experiencing losses is also forced to react to those losses by liquidating some of its assets. Right? So that comes back to what Raphael was saying yesterday, is that there is an endogenous effect of a fund who is first experiencing a big loss and then has to react to the loss because of lots of diverse potential reasons that I'm going to cite afterwards, right? And so if we use value at risk or expected shortfall as is, we're just looking at a measure of the mark-to-market risk, right? And never taking into account the liquidity of the assets that are in the portfolio and the liquidation effects that can happen when an institution is kind of cornered and has to liquidate some assets, right? So to put it simply, if I have two portfolios which have had the same statistical behavior in the past, for example, but one is much more liquid than the other, if we just use VAR or expected shortfall, we'll get the same risk for those two portfolios, right? Because VAR or expected shortfall or the classical risk measures do not incorporate any measure of liquidity. And so the result is a very massive underestimation of portfolio risk, because while market risk is taken into account in a proper manner via the classical modeling of financial assets and the calculations like value at risk or expected shortfall, the liquidation risk or the liquidity risk is completely forgotten. Right? And there were actually several risk management fiascos which kind of shed light on that in a repeated manner, right? So it's not something that's new that people just discover now, but it's just that it's happening regularly, that you have some big portfolios which have a certain risk, exposed, displayed risk, which is actually not in line with the realized risk when things go bad. One of those examples is the example of the London whale, so the one that we are taking here that I'm going to discuss in the last part of this talk, but there's a lot of other ones, right? So these considerations call for a comprehensive approach for integrating liquidity or liquidation risk into the existing risk measures. So I'm not saying that we should forget about what's being done, not at all, and actually there's a lot of very sophisticated approaches which have been proposed to model risk, right? But it's just to incorporate this feature which is generally not incorporated yet, which is this liquidity or liquidation feature. And so if we want to do that, we have to build a model which kind of takes into account the positions of a fund in each asset, but as a function of taking into account the liquidity of those positions. Right? All right. So maybe before going to the model, why does a fund liquidate after a shock? It doesn't seem optimal at all, right? So because once a fund has lost a large amount of money, you wouldn't want the fund to start liquidating stuff, right? Just after a loss. But actually, there's very often exogenous constraints which force a given financial player to act in a certain manner. And especially if you look at losses, at big losses in the financial market, very often you have capital requirements or risk requirements which will force an institution who has suffered a big loss to react to that loss by selling some assets. Right? So the best example is if you look at a fund which has a leverage constraint. So you know leverage is the size of assets divided by equity. So it's actually a measure of how much you borrowed, right? So it's a measure of one kind of a measure of the risk of your portfolio, right? And very often fund managers have try to have a maximum leverage, and so they would try to have at all times the leverage of the portfolio that they build lower than a certain maximum amount. Right? So typically for a bank, it's actually something around 30. Right? So the last Basel regulation would give 33. And if the fund experiences losses, the loss that the fund experiences is actually going to be absorbed by the equity. Right? But mechanically, that's going to make the leverage of the fund increase. So I'm a fund, I have a certain maximum leverage, let's say it's 30, and I experience a loss, so I start at a leverage of 25, and experience a big loss, and so my leverage is going to increase above 25, right? And if actually the loss is large enough, so typically larger than this threshold, which is here, I'm actually go above my limit of 30, and I'm going to go above that. Right? And now I have to react to that. Right? Because my rule, the rule that I follow to build my portfolio, which may actually be in my contract, right, with my investors, is that I have to have a maximum leverage of 30, let's say. Right? So how can I react when I have a maximum leverage? When I'm too leveraged, there are two easy ways to react. Either you raise equity, so you sell new shares of equity, which is actually something that financial institutions will tend to avoid to do, because it dilutes investors, and especially it's very costly after a shock, right? Or you sell assets. And that's actually, and it's actually documented in several empirical studies that after a large shock, financial institutions will tend to sell assets in order to decrease their leverage, or actually for banks, increase back the capital ratio. If you look at that, the reaction is actually a deterministic reaction of the shock. So here on this x-axis here, you have the size of the shock, and here in this blue line, you have the reaction of a fund which keeps a maximum leverage. So you see that as long as the shock, so of course for a certain value of parameters, right? So exactly the ones that I told you, you start with a leverage of 25, and the maximum leverage is 33, which is actually what the Basel regulation would give you for a bank. You see that as long as your loss here is not too big, you don't do anything. You don't deleverage, right? But After that, you have to sell assets. And of course, at that moment, you don't want to, right? But you are forced to sell assets because you want to bring back your leverage below the 33 limit. Right? So this is a classical endogenous reaction of a financial institution to a given shock. Right? So let's try to model that in a simple framework. So how do we do that? We look at a discrete time model. So time step is delta t. So let's say it trades every day, right? You have n assets, and let's say for simplicity that the fundamental return of the asset is following something like a Black-Scholes, right? It's not necessarily actually a Black-Scholes, but let's say to simplify, it's a Black-Scholes. So psi here would be Gaussian, and you have a covariance matrix of those psi, which would be capital sigma, which is a fundamental covariance matrix, right? So you should think of sigma as a fundamental structure between the asset returns of on this market, right? So if the assets in the market followed fundamentals, so it's very difficult to define what fundamentals are precisely, but let's say if we had fundamentals, the covariances, the correlations should be this capital sigma. Right? So that's the classical modeling, and actually if you look at sophisticated modeling of risk models, they would put a lot of sophistication into the sigma. Right? So they would say, okay, sigma is a Heston, multidimensional Heston, or V-chart, or stuff like that. Right? So what we do is that we don't here put too much complexity in the sigma, but we add a fund, right, who has positions alpha 1, alpha 2, alpha n, right? And so it has a benchmark value, so it's kind of an index value, right, which is the sum of those alpha j, skj. And so, of course, due to the movement over one day or over one period, the value of the fund moves also. And what we know is that if the fund loses too much, it's going to be forced to react, to sell assets. Right? So how do we model that? We model that in a very generic manner by introducing a deleveraging schedule F, right, which is going to capture, to quantify how much a fund liquidates as a function of its loss. Right? So in the example that I gave you, F is just this blue line. Right? But for the purpose of the model, here we take a generic F. Right? So if you're a fund, you know your constraints, so you will know your F. Right? That's the thing which is important here. Right? And the assumption that we make, so another assumption that we make is that if your rule here tells you that you liquidate 10% of your portfolio, what you do here is that you liquidate 10% on each asset of your portfolio. So you do a proportional liquidation, right? So that's something that may be relaxed, but for the purpose here of the model, we do proportional liquidations. So the thing when you liquidate assets is that has an impact on prices, right? And we capture this impact by introducing here a market depth DI, which is a linear measure of the liquidity of the asset, right? So the larger the DI, the larger the liquidity of the asset. So if you look at the final dynamics of the price dynamics is the following. So you have the return over one day or over one period is a fundamental return. So you know the one with the covariance matrix of sigma, minus something here which is systematic here. Right? Most of the times, this thing here is equal to 0. Right? Because this F, there is no liquidation going on. Right? But in the extreme scenarios, so when the losses are very large for the fund, this thing will not be 0. And that's actually the scenarios which are the most interesting for calculating risks. Right? You look at the worst scenarios, actually in the worst scenarios, this thing is not going to be equal to 0. Right? And in the case where the fund has positions alpha which are not negligible compared to D, that is the liquidity of the asset, the fact that the fund liquidates assets is going to further impact the price of this asset. Right? So you can imagine a spiral of losses like that. All right. So that's a discrete time model, and well, it's very useful for simulations, and actually it's a Markov chain, so there's a lot of simulation results that can be used. One thing that we did is look at the continuous time limit of this model. So I actually presented a few techniques to do that during the mini course to look at what's the limit in weak convergence of this Markov chain when delta t goes to 0. And so the limiting diffusion is actually written as that. So here you have the limiting price dynamics, which follows an SDE, with a certain drift and a certain covariance matrix. Right? So I'm not insisting too much on the drift, but if I look at the covariance matrix, I see that the realized covariance matrix in the presence of feedback effects is actually equal to capital sigma, so the fundamental covariances, right, in the market, plus terms in red here. And those terms in red are actually generated by the fact that the fund itself is reacting to prices. Right? Of course, those factors disappear when D is infinite. So D is hidden in the denominator of this vector capital lambda. So when D is infinite, so the liquidity is perfect, all those terms in red disappear, and we are just in a Black-Scholes framework, right? But when there is illiquidity, so not perfect liquidity, and the fund liquidates, so F prime is strictly positive, so there's something going on, the fund liquidates. This is not equal to 0, and actually what you see is that the realized correlation are modified, they're not the same as what you expect, because you expect sigma, right? And it's modified. And what's interesting is that it's actually, the change depends on the fund's own strategy. It's the fund itself which is going to make the market, the correlations be deformed and make the market move. Right? And correlations become actually path dependent, right? It depends. They start to depend on the movement on the losses which were generated to the fund. Right? And so, if you look at these kinds of models, right? As I told you, most of the times those terms in red they are equal to 0 because most of the times there is no the losses that a fund undergoes over one day are not large enough so that the fund is forced to liquidate, right? But in the worst scenarios, actually, those terms in red have to be taken into account, and that's something which is not taken into account in the classical risk management frameworks. Right? So if you look at this model and now look at value at risk as an example of a risk measure, which is usually which is used a lot. Here on the x-axis, you have the size of the fund, right? And in red, you have the fundamental value at risk, so you know the one which is just taking into account the mark-to-market risk, which is something linear in fund size. And in blue, you have the one coming from the model here, right? Which is sublinear, right? So which shows that if you multiply the size of a portfolio by 100, the risk of the portfolio is multiplied by more than 100 because there are some liquidity issues there. Right? Because if you multiply the size of a portfolio by 100, the liquidation costs of this big portfolio will be much higher than the liquidation cost of the small portfolio. Right? So that's something which can be tracked, quantified easily in the kind of models that we developed. So let's try to apply that to the London whale, so to give a little bit of practical example. So what's this London whale story that I'm talking about? So in 2012, the Chief Investment Office of JP Morgan experienced huge losses of 6.2 billion while unwinding very large positions in CDS indices. Right? And that actually occurred when they liquidated positions in the CDX IG9. So IG9 is one type of CDX on investment grade, and 9 is the number of the series of the CDX, right? And the portfolio that was built by JP Morgan was actually a very complex combination of long-short of CDX indices, and actually it was a super big portfolio. So that's why the trader, who was actually a French trader, yes. But the size here, yeah. So this guy, this big trader, was called the London whale because he was building so big positions compared to the liquidity of the asset. So if you look at what Raphael was saying, if you look at the IG9, which is a liquid index, the positions built up by JP Morgan CIO was actually in IG9 40 times the average daily volume. So it was a super huge position. But if you look at how the risk was computed, and that's actually something which is the topic of some Senate reports, right? So it's not just me saying it, there's official reports showing that, is that the risk was computed in the very classical manner, so using the linear risk measures such as value at risk or expected shortfall or stuff like that. Right? And if you look at the risk, actually, JP Morgan calculated a risk of 500 million for this portfolio, while in the end, when the portfolio was unwinded, the real losses, the realized losses were actually 6.2 billion. Right? So there was a lot of criticism which was made on JP Morgan risk management, on how they tried to hide the losses and etc. But actually one thing that was not done by JP Morgan was to take into account the liquidity of the positions there. Right? So if we try to actually and something that is very remarkable and that shows that there is a big effect of the liquidations of the London whale is if you look at the realized correlation between CDX IJ9, so it's the one that was liquidated, and CDX IG10, which is another one close to IG9, but that was not liquidated by the London whale. You see that they are close, so the realized correlation from 2010 to beginning of 2012 is almost 1. Right? And then liquidation starts, and you see how correlations break down. There is no fundamental reason for correlations to break down here, right? It's completely linked to the fact that there was one big player who was pushing some large sales on one of those two indices, right? And so if we try to calibrate the model that we had and calculate the 95% 5-month value at risk for positions in CDX IG9, so 5 months is actually the length of the liquidation that JP Morgan took to liquidate this big portfolio, you see something like that, right? So this in red is the linear value at risk that is used in general, and this is the one given by the model that we use ourselves, which is of course sublinear. And if you look at the values of the risk, yes, superlinear. Yeah, sorry. Yeah. And the values of the value at risk, we find a value at risk, a risk for this portfolio of 12 billion, which is much more than the 500 million, which was actually computed by JP Morgan. Right? And the difference between those liquidation adjusted VAR and the benchmark VAR are actually reflect the liquidation costs. Right? So most often those liquidation costs are negligible, right? Because players are not big and players are not forced to liquidate. But for big institutions that are forced to liquidate, which is actually what happens in the bad scenarios, there are something which are significant and which actually can represent a sizable portion of their losses. Right? So maybe to conclude, yes. So the thing that we did in this paper was to provide a tractable framework to incorporate liquidation risks and liquidity risk into the classical risk frameworks, right? So it's not the idea is not to just provide something new. It's just start with your own favorite risk management model, right? It can be probably not Black-Scholes, but something which has fat tails or something like that, and then you add on to that the endogenous effect which is generated by your own trading, right? And this is something which is very important when you're a big institution, because when you're a big institution, you know for a fact that when you have to react, you're going to impact prices, and it's always going to be adverse for you, right? Because you're going to be liquidating positions that you are holding, right? And the framework that we propose is actually very simple. We just add a linear impact, and you have to know how to calculate how much you liquidate. So if you're a bank, you know that you have a certain deleveraging schedule. If you're a mutual fund, you know you have another type of deleveraging schedule. And then you have an impact on that, right? So of course it can be refined, right, in a much more sophisticated manner. But that's a starting point to propose more sophisticated models that incorporate those liquidation risks. Right? Thank you. I'll end here. Thank you.